In the following lesson, we're going to be looking at Forex and how it operates as a market. The presentation that I have prepared for you is one of my favorite presentations of all time. If you're at all interested in trading the Forex market, the following lesson is for you.
Let's have a look at why people want to trade Forex. It's a great lifestyle. You can trade from the beach and make good money. Forex market trades trillions of dollars. I only need to take a tiny amount of that and I can get a full-time income. Regular people are doing it, so can I. Lots of opportunities. The market trades constantly, so I can work when I want. A leverage means that if I get good, I can scale up and make millions. If you've been on social media before, this is the type of typical shit that you're going to see. A lot of Forex accounts flexing wealth and flexing lifestyle as well. You'll see a lot of this type of posting. And this is super seductive to normies. The fake Forex trader lifestyle is all over social media, and it's the easiest thing in the world to fake as well. You can hire some cars, go to a nice location, take 100 photos, and drip feed them out over months. Forex posers do it constantly. And if I'm being fair, rich people do it all the time too. It's a valid, social media strategy. However, when we're looking at it through the context of why you become interested in this in the first place, people can hire a Lambo for a couple of hours, buy a stack of fake Hollywood money online for only a couple of $100, and just take shitloads of photos of it. It costs even less to take your shitty MacBook to the beach and take a picture of it. And this is one of the main ones that I see people getting seduced by all the time, because it plays on people's humility. It's like, yes, maybe I don't want the Lambo, but it would be nice to just escape work. If you're the type of guy that's going to work all the time, you're like, oh, I just want to escape the rat race. No. Earn from the poolside only with a phone, or pictures of laptops on the beach is like crack cocaine for retards. This is the professional trader reality. And it is literally this for 16 hours a day for 5 to 10 years straight. If you want to become a professional full-time trader, you must completely become a degenerate when it comes to investing and trading technique and screen time. The amount of education that you need to put through yourself, you need to be a self-starter, and you need to be fully dedicated to being in the seat at all times. This is the reality of trading. There is no beach. There is no phones. There's only pure suffering. But wait, it gets worse. Think about the incentive structure for these Forex influencers with their affiliate links. It's usually in the form of IB agreements, introductory broker agreements. This is where they get commissions on your investing and trading activity, which is a massive conflict of interest, because they're quite literally paid on the volume of fees that people generate from pressing the button, which is typically why there is a strong emphasis on day trading. Can you start to see why? The more button presses that they can get you to make means they get more affiliate commissions in a shorter amount of time. But I hear you ask, what is inherently wrong with day trading? Buckle up, because we're about to get started. But first, let's have a quick look at seduction via volume. This is a classic one that I hear all the time. Forex markets are trusted because they've been around for so long, and they trade such high volumes. If I just get involved and I take a little bit of money, then they won't notice that it's missing. I'm just like, a little squirrel, just jump in, grab a couple of little morsels, get straight out. I mean, look at this. $6.6 trillion a day. In 2022, down the bottom you look here, almost $2.5 quadrillion of annual volume. Not too bad. Makes you think to yourself, well shit, why don't I get involved in that? Seems like that's where the money is. Wrong. Volume numbers don't mean anything, but I only want 10K a month and the Forex market trades 2.5 quadrillion annually. I'm so humble. No. 2.5 quadrillion isn't the amount available to be taken. It's just the transfer volume. That's it. It's not like you can deposit your money in a bank and be like, oh, yeah, but my bank transfers $1 billion a day. Therefore, if I put my money in the savings, they might give me some of those billions of dollars. No, it completely does not work like that. This is such a basic logical fallacy that I'm perplexed that any human could even fall for it. And I've seen this dozens of times. One of the quotes that haunts me was somebody just said, yeah, but it's like a big river of money. I just need to dip my cup into it and take out what I need, to be humble. No, fucking idiots. But wait, it gets worse. Yes, it gets worse. More volume which equals more liquidity, which means it's harder to move markets with volume. This means lower volatility, which means fewer opportunities over time, which means people need to go down into lower time frames to extract moves. Over like the minute and the second time frames, people seem to be obsessed with these low time frames because the volatility in Forex markets are usually so low. This is quite literally equal to people being herded into the high frequency trading algorithmic meat grinder like cattle. Yes, this is you down the bottom, and yes, the Terminator is eating your stops. You have to understand the technology that you are deciding that you want to be put up against. There exists in all markets an army of Terminators in the form of institutional grade investing algorithms. These programs have one job, and one job only, and that is to exploit any and all market participants to the highest degree possible at light speed. Every possible game theory application, every obscure behavioral data point which can be leveraged is run through artificial intelligence systems which can simulate and optimize trades against every market participant in the world at 100 million times per second. Every hedge fund hires doctorate-level mathematicians, statisticians, game theorists, and financial geniuses to design these perfect killing machines in an algorithmic race to zero. Zero being when there's no more market edge to extract. You cannot comprehend how fast these algorithms are, nor in what creative and incomprehensible ways they're exploiting you. The Forex market is their favorite because of this high liquidity. You have to understand, Forex market participants are mainly financial institutions, hedge funds, investment managers, multinational corporations, as well as commercial investment and central banks. Do you really think that you have a chance against these behemoths who have spent billions of dollars in research over decades to kill as many other people in the market as possible? You have to understand the reason why we're so tunnel visioned on crypto is because we want to escape this competition. And people that want to trade Forex are implicitly choosing to make the game harder for themselves. The lack of liquidity in crypto markets is what makes it an oasis for retail traders. So this is where the psychology comes into it, where tunnel vision and illogical outlooks seem to propagate. The wrong outlook is that I want to make money trading Forex. The right outlook is I want to make money and I will go where the money is. Uninformed tunnel vision on a single market will not make you money. Only an analysis of the total playing field can do that. My tunnel vision on the cryptocurrency market is coming from an informed position after several years of actively comparing and contrasting different markets. Can you claim the same? Literally ask yourself, what experience do you have in comparing and contrasting different markets, doing like deep analysis on this stuff? This same analysis is why I used to make more money in commodities than I did in Forex, stocks, and bonds combined before crypto became mainstream. I didn't care what market I traded, as long as I found the right edge to make money. In Forex, there is no edge, but I know a guy who does it. No, you don't. Everybody knows somebody who does it full time. Trust me, I've known plenty of them who flex the lifestyle, post shit all over social media about how smart they are. They share their analysis, their little screenshots of their P&Ls on random days. When the time comes to share P&L on demand, or when you hit them up 12 months down the line to ask them how they're doing, they have 100 excuses. They all fail. This is a statistical fact, and it's akin to telling me, I know a guy who makes full-time income playing at the casino. No, you don't. Can you comprehend how transparent these lies are? Still don't believe me? Excellent. Time to unleash my final technique. Raw mathematical truth. Recognize these models? I didn't think so. If you did, we wouldn't be having this conversation. The normal model is one of the most beautiful models in mathematics. It represents the probability density of a series of data points. Not all data series fits the normal model. Only random and naturally occurring phenomena reliably fit, such as the height of trees, solar radiation reaching Earth's surface on an average day, a person's finger length, or the fucking price return series of a financial market. As you can see, return distribution samples over different time horizons. We have half an hour, 60 minutes, 240 minutes, 1440 minutes. And take a good look. Just chill with this for a minute and just have a good solid look at these price returns. Notice anything similar to all of these? The mode, the median, and the mean are all equivalent to the average returns, the center of this probability distribution. And you can see how they all center around zero. Now, does this not tell you about the characteristic behaviors of this market? and the return price series. Look, even if we get a return price series, a probability distribution of something where we're trying to get an edge in the market. This is just an example, by the way. You could do this for any type of statistical edge that you're trying to find in the market. This one just happens to be based on bullish engulfing candles. Look at where the median and the average is. 0. They're all at 0. The average returns are 0. You can look at the skews and say, well, there's a little bit something going on here. Can you see how symmetrical this return distribution is? But actually also take note, this is also an important one I almost forgot, take note of the frequency. 7,000 samples of just that one bar, and then 7,000 samples of the next bar, and the next bar, and then we go down to 6,000 samples here and here and here. There would be hundreds of thousands of samples in this one study here. And then we can look at this same one here. This is a good example, bullish engulfing patterns and bearish engulfing patterns. And we can see that the mode here is very, very close to 0, where this dotted line is. And you could make the argument that there is some sort of edge here, and that there is something in the Forex markets that you can extract out of each of these different techniques. But look at the frequency. Look at the frequency. This frequency is for each little point on this curve. There are tens and hundreds of thousands of samples in each of these distributions. Now, if you're going to try and tell me that, yes, there is an edge and I'm going to trade bullish engulfing patterns, in what universe are you going to sit there and place 10,000 trades and receive an average return of 0.05% and then tell me that you want to be a successful Forex trader using one of these different techniques? Fuck off. But the technical analysis. This one's great. People believe that their squiggly lines do something. Technical analysis is astrology for men, deluding ourselves into thinking that our chart finger painting has any sort of significance whatsoever is a thought crime of the highest degree. Worse yet is the classical practice of setting the risk-reward targets at a 3-to-1 ratio, which is commonly taught. If the market has a normal distributed return profile and you place the stop loss 3 times closer to the mean, the probability of getting stopped out is like 20 times higher due to the kurtosis of the distribution function. Kurtosis being the shape of the distribution curve and how fat and skinny the tails are relative to the body of the distribution. Literally, look at this. Probability density. Look how high up the interception is between the stop loss placed at 1 versus 3 over here. You really think that your take profit's going to get hit when it has a probability density of virtually 0. Literally think about the statistics of what you're trying to achieve when considering the very realistic fact that there is no edge. And you're telling me that with a 3-to-1 risk-reward ratio, where your stop loss is 20 times more likely to get hit, that you're going to make money out here with a probability distribution of essentially 0. But ultimately, you don't even have to trust the theoretical analysis when the killing blow serves itself. There has been research which shows that 99% of Forex traders fail to make profits for more than 4 continuous quarters. Trade Forex for a year, you think you're going to make an annual income from it? Get real. Absolute pure delusion. With that being said, let's have a quick think about some genuine methods, ways that you can make money in Forex. You can use market regime analysis with portfolio allocations. So this is more of a long-term time horizon based method on a month-to-month and quarterly average return basis. You can extract the probability and average return profile for things like the US dollar. US dollar is probably the main one here. If you pull out the percent positive ratio and the average return from the US dollar during different market regimes, you can actually get a decent edge there and you can trade it over a month-to-month basis. But like I've mentioned before, but due to the intensely high liquidity of the Forex market, the probability of making any decent money out of the Forex market just holding a long only or a short only position, cash position, man, you're in the single figure percentage points, maybe in the double digit percentage points, but even then you're trading on something that is inherently kind of drifts up and down. It has no inherent edge in there. So your analysis needs to be on point. Your market regime techniques need to be locked down, and you have to have very good quality data. So you can do swing trading based on opportunistic macroeconomic events. So we can look at news kind of stuff like recessions, war, sanctions, resource boom and busts, and monetary and fiscal policy differentials. I would recommend doing all of this stuff quantitatively. And you can go short-term trading using algorithms, non-discretionary only, quantitative research on a deep level you need to do and learn multivariate regressions, probably AI, machine learning, and yeah, then have like server farm levels of backtesting and genetic optimization on a regular basis. If you're going to be going into the short-term realm, it's absolutely possible. But at the end of the day, are you really going to be spending weeks and weeks and months designing and then maintaining these algorithms when you could be doing something else? Like in a market that has a tailwind essentially that runs in your favor at all times and has low institutional participation to the degree where it makes the alpha more available for retail traders. Are any of these methods worth it for the time investment relative to the other opportunities that you have? No, not really. Not when you have access to less competitive markets with higher returns. So I'd say don't suffer for no reason, invest in crypto. With all that being said, thank you very much for listening. If you have any further questions, please don't hesitate to hit me up. Thank you very much, guys. Talk to you soon.